All right, good morning, everyone. Hope you're coping with load shedding reasonably well. Difficult time in South Africa. Wow. There's a huge amount happening, obviously, in financial markets. I must say, this is pretty much the busiest start to the year that I can remember. You've got to kind of try and evaluate what's going on an hourly basis, data coming out. Before you start each presentation, you're kind of checking the news to see if somebody has done something really radical. So significant number of developments, and I would say quite tricky to stay in touch with all of that. So in this webinar this morning, we're going to focus on the Russia-Ukraine crisis specifically. We're going to delve into not so much the mechanics of the crisis or the politics, but really focus on what this means for financial markets, what this means for the South African economy, how policy officials are responding and likely to respond to this. So quite a lot that we want to get through. Russia's it's generally not an economy that we have spent a huge amount of time analyzing, right? And even though Russia is part of the BRICS, there isn't a huge interaction between South Africa and Russia. Obviously, our politicians like to go there for medical treatment for some reason or other. But, and there are historical links to the ANC, but in terms of the economic link, it's not as strong as you might envisage. So I was looking at South Africa's trade with Russia, and our imports and exports are less than 1% of our total trade. Now that's not nothing, but it's small in the context. And if I look at our trade with the Ukraine, it's less than 0.1%. So very small. It's not an area that a lot of companies do business with. Russia itself is only 1.7% of the world economy. So as an economic system, it is fairly small, but gee, it can cause havoc as it's doing at the moment. And a lot of that havoc really comes through the markets and comes through their role in the oil market and their role generally in commodities, I guess. And part of it comes through their strong relationship, trade relationship and financial relationship with Europe. So you would say that Russia is having a much bigger effect on the world economy than the size of its economy would suggest. And we've known that, right? Politically, they have a huge effect. Militarily, they obviously have a huge effect. So it's something we've got to focus on, and the impact on the markets is enormous. So we've got to unpack this in a fair amount of detail. The Russian economy itself is being decimated. The sanctions are systematically hurting. So if you think at the start of this year, the Russian economy was forecast to grow at almost 3%, 3% GDP, not spectacular growth, but decent growth. They had been putting up interest rates. And now we're talking about a very severe recession within Russia, as huge numbers of businesses close, unemployment rises, inflation surges. You know, they've put up interest rates to 20% from just over 9%, so a massive increase in interest rates. Their 10-year government bond yield has jumped to 20%. So the numbers are changing dramatically and the impact is huge. The thing that jumped out of me when I looked at the data on Russia is their credit rating. So this week, Fitch downgraded Russia's credit rating further. But believe it or not, at the end of February this year, Russia had an investment grade credit rating, a credit rating above South Africa, a triple B. Fitch gave Russia a triple B credit rating, investment grade. And from the 1st of March till pretty much the 8th of March, Russia's been downgraded 12 notches on their credit rating, and they are now a C rating. And if you go below a C rating, you are into default rating. So that's how far Russia has fallen. And when Fitch put out their note on Russia, they said the credit rating currently reflects the risk of an imminent default. All of that in literally 2 weeks. Phenomenal how it's all changed, and changed very badly for Russia. And obviously, it's got implications for everybody in the world, as we'll chat now. So in order to delve into this in a bit of detail, we've asked Mike Bell from JP Morgan. Mike is a global market strategist based with JP Morgan Asset Management in the UK, and he's perfectly placed to give us a sense of how this is impacting financial markets, how it's impacting the region, particularly Europe and the US. And so Mike's going to chat through some of the dynamics from his perspective. He's going to take up about 20 minutes or so. He's going to use some charts. And then after that, I'm going to just focus on what this means in the South African context. I'm also going to use a few charts around about 20 minutes. And then we will hopefully have some time for questions. So if you want to pose questions, please use the question box. I'll be monitoring that as we go along. I know a lot of people are concerned about load shedding and that their system might go down, etc. But this is being recorded and it will be available. So if you get cut off, firstly, I apologize. And secondly, you can view it at a later date. Also, the presentations are available and will be made available. And in addition, if you're looking for something else, give us a shout. Maybe we can help. We certainly don't have everything, but we can maybe delve into some specific areas if you want that and you're kind of struggling to get hold of that information. So please, that's an open invitation if you're looking for additional information. As I say, things are evolving literally day by day. We'll talk a little bit in the webinar about how this plays out. So we're going to look at a couple of scenarios, but I must say that as you go through the scenarios about how this could end, because that's a critical thing. What's the end game here? Gee, you're just guessing. A lot of this stuff, you're just guessing. So we'll delve into that a little bit, but we certainly don't have the answers as to what is in Putin's mind. So with that as a bit of an introduction, I'll hand over to Mike. Mike's going to share some charts and then go through his discussion, and then I'll come back and talk through the implications for South Africa. Thanks a lot, Mike. Thanks for making the time. We know that you've got a cutoff at 11 o'clock, so we're very conscious of time, but we really appreciate you taking the time out of your day to be with us and to share your thoughts. Thanks, Mike.
Thanks very much, Kevin, and thank you everyone for joining. Good morning. So yeah, if we can bring the slides up, let me just talk through how we're seeing what the impact of everything that's going on in Russia and Ukraine is on the global economy. So if we turn to the next slide, the main impact is on global commodity markets. If we could just move forward one slide. Russia is an enormous producer of commodities. I'm not sure the slides are working there, but anyway, let me talk through it. For Europe, about 38% of all all natural gas comes from Russia. About 23% of Europe's oil comes from Russia. On a global basis, it's not just energy you've got to think about. You've also got the fact that wheat, about 18% of all wheat that Europe consumes comes from the Russia and Ukraine combined. So the main transmission mechanism of this terrible conflict that's going on in Russia and Ukraine at the moment is through the commodity channel. And it's going to lead to significantly higher food prices, which will have implications, particularly in some of the emerging economies, but also in the West, where food prices will contribute to higher inflation. But of course, really what markets are focused on is the impact of higher oil prices, particularly on the US economy. And in Europe, it's really the focus on the gas price and what that could do to the European and UK economies. Because if we look at the next slide, look at that chart on the right-hand side there. This shows you US and European gas prices. And the key point really is that the global gas market is not as global as you might think. So if you look at the chart there, you can see that yes, gas prices, this is natural gas prices in the US, They have risen a little bit, but nowhere near as much as gas prices have risen in Europe. And in fact, UK gas prices look very similar to those in Europe. Now, you go back a couple of days and you were looking at prices in Europe of over 200 euros per megawatt hour. In the last few days, that's come down, and in fact, overnight declined a little bit further, now to about 125 euros per megawatt hour. Now, that's less bad than it was at the peak, obviously, but it's still about 60% higher gas prices than Europe had over this last winter. So if gas prices stay at the kind of levels that they're at now, then it's going to cause a severe squeeze on both European and UK household incomes, particularly as we get through to next winter and people have to pay much, much more to heat their homes. So the risk is that it could squeeze on consumption, and that could cause a recession in Europe and the UK. Whereas in the US, that risk is much smaller because, as you can see, the feed through into gas prices has been much less. And the simple reason for that is because part of the gas market is international, the liquid natural gas market that can be put on a ship and sent across oceans, but large parts of the gas market comes through pipes, for example, from Russia into Europe, and that gas can't go across to the US, and likewise we can't take a lot of the piped gas from Europe, from the US, and get it to Europe. Now, how the worst case scenario is that the gas actually gets shut off. As I said, 38% of all European gas comes from Russia. In the event that Russia shut the gas off, it would cause very severe problems for the European economy, because you'd be looking at having to shut down parts of the industrial complex within Europe to kind of ration access to gas for households. So that's the worst case scenario. My base case since this all began has been that that wouldn't happen. And at the moment, the big spike that we've seen in gas prices is being caused predominantly by the market pricing in a risk premium, essentially the risk that that might happen, rather than there actually having been a disruption to gas. The gas is still flowing, as we speak today, from Russia into Europe. Of course, the risk is that as the conflict in Ukraine escalates, something could happen, either accidental, pipelines get hurt in the conflict, or either Europe decides to stop taking energy from Russia, or Russia decides to retaliate to sanctions by limiting or indeed cutting off the gas supply. Now, the reason I put this chart on the left-hand side in there is to show you the extent of Russia's exports. And you can see that if you really want to hurt Russia, if the West wants to really hurt Russia in retaliation for what they're doing in Ukraine at the moment, then the way to do it is to stop importing oil from them. And that's what the US has done, it's what the UK has done, but fundamentally, Europe has not done that. And actually, very little Russian oil goes to the UK or the US, so it's not a major deal for those economies to cut it off. But about half of all Russia's oil exports go to Europe. And so far, we've not seen Europe saying they won't take Russian oil. And I think part of the reason for that is, A, of course, because it would hurt the European economy if they did say they weren't going to take Russian oil. But B, it could well lead to a situation where the Russians retaliate and say, well, if you're not going to take our oil, but you'd still like our gas, well, we're not going to provide you with that gas if you say you won't take our oil. Because you can see, of the total Russian exports, only about 8% of it is not natural gas to Europe. So the gas matters more to Europe than it arguably does to Russia. So that's the risk. At the moment, as I say, gas prices are actually coming down, but the key question is going to be in Europe and the UK, do gas prices continue to fall? Do they come back down to the kind of levels we were at last winter? in which case it's not so much of a problem? Or do they stay at these elevated levels, still about 60% above last winter's prices? If they do, the risk of a recession in Europe and the UK is quite high, unless, of course, the governments in Europe and the UK step in and give money to consumers to help them deal with the fact that their gas bills are going to be higher. So that's one thing we're going to be watching very carefully. And really the two key questions that I'd want to know the answer to, but that are frankly impossible to predict, are, what is going to happen to gas prices and oil prices, and what is the fiscal stimulus, to what extent the government's going to offset those higher prices for consumers in Europe and the UK. But as things stand at the moment, certainly the risk of a recession in Europe and the UK is a lot higher than it was just a couple of months ago. If we look at the next slide, obviously with markets, you've always got to ask not only what are the different potential scenarios, but what's already in the price. And this shows you the extent to which European equities, looking at Eurozone equities, have fallen from their peak during past periods of market turmoil. And then this was done yesterday, and then yesterday the market fell a bit more by about another 3%. So European equities are now down about 17 to 18% from their peak. As you can see, during very severe financial crises like the global financial crisis or the bursting of the tech bubble, the dot-com bubble, equities went down very, very significantly. But during more normal or moderate recessions, even during the COVID pandemic, you can see equities fell by less, in the region of sort of 30%. If you look at the recession in the 90s, the sovereign debt crisis, which was a pretty significant recession in Europe, and of course COVID, where the European economy was essentially closed for a period of time, stocks fell by about 30%. So it's fair to say that the market is pricing in a relatively high probability of a European recession already. Not perhaps fully priced, but it's not like the market hasn't already got quite a lot of bad news priced in. If we look at the UK, where the risks are similar because of the gas price mirroring what's going on in Europe, on the next slide, the UK market, the FTSE 100, which is what most people think of as the UK market, has held up pretty well. That's the grey line on this chart. But the FTSE 250, which is the mid-cap part of the market, has gone a lot further towards pricing in a kind of more normal, moderate recession. If you look at the 90s, there you can see that the mid-cap stocks fell again by about 30%, and so far stocks are down about 17%, kind of similar to what we've seen in Europe. The reason the FTSE 100 has held up so well relative to the mid-cap is because there's a large amount of mining and energy companies in the FTSE 100. So it's that blue line, the mid-cap stocks, which are more reflective of the actual UK economy. The FTSE 100 itself has relatively little exposure to the actual UK economy. It's got a lot of foreign listed mining and energy stocks. So I think the key point is recession risk in Europe and the UK has risen, but the market has already moved quite a long way to pricing that risk in. It's not to say that there couldn't be further downside, but it's not like the market has completely ignored this risk. What about in the US? If we look at the next slide, gas prices in the US are not being affected in the same way, but the US is exposed to higher oil prices. You can see how sharply oil prices have moved over the last couple of years. Obviously, initially, as we came out of the pandemic and people started driving and flying again, oil prices went back to kind of pre-pandemic levels. But then the conflict in Russia and Ukraine has led to a significant further spike in oil prices. So whilst the US is more insulated from the gas perspective, there is still a risk that higher oil prices will weigh on growth in America. How worried should we be about that? If you look at the next slide, the key risk is that it squeezes consumer incomes. And what I've shown here is real income, so wage growth taking away inflation, going back to the 60s. And at the moment, wages are growing by about 5%. Inflation on the latest numbers yesterday, which is not shown on this chart, came in at nearly 8%. So you've got real wage declines of about 3%. Now, if you look at the chart, I've highlighted a few points in history with the green circles there, where real wages were negative, but you didn't get a recession. So it's not like every time that real wage growth turns negative, it leads to a recession. But as you can see, if you go back to the 70s, where you had very rapid and very severe squeezes on real incomes, you did end up with recessions. And of course, those squeezes on incomes in the 70s were caused by disruption to the oil supply from the Middle East, much in the same way that the conflict in Ukraine could threaten the oil supply coming from Russia. So that is of some concern. However, there are some offsetting factors. If we look at slide 8, this is data from the JP Morgan retail bank in the US called Chase. It's not every consumer in America, but a large proportion, approximately a third of Americans bank with us. And what we're doing here is aggregating the amount of deposits that they have with us and looking at the median and indexing it back to where it was at the beginning of the pandemic. And what's fascinating here is that you can see during the pandemic, US consumers saved a lot of money, their deposits went up. That second spike in April of 2021 is when the second stimulus checks came through. And you can see that it peaked, people's savings peaked at about 150% above where they were at the beginning of the pandemic. Over the last year, they've spent some of that, they've used a bit of it to pay down some of their debts, and some of it's been invested in the stock market, and that's caused the US economy to do very well. But as of where we stand today, the median consumer in the US who banks with us is sat on still about 80% more savings than they were at the beginning of the pandemic. So as they face these higher oil prices and paying more to fill up their cars, US consumers have some savings that they can dip into to help them pay those additional costs. So that makes us think that if oil prices stay where they are at the moment at about $110 to $115 a barrel, it will slow the pace of growth in the US, but probably not cause a recession. Of course, if oil prices were to spike materially higher in a worst case scenario and go to $150 or more, then that could cause problems in the US and potentially even tip it over into recession. But at the moment, we think they can withstand it. The other thing to be aware of, if you look at slide 9, is that in the 70s, where you got that squeeze on real wages, where oil prices went up very sharply, and it led to recessions both in 73 and at the end of the 70s, it wasn't just higher oil prices that were squeezing consumers. But as you can see from this chart here, the central bank reacted to those higher oil prices by slamming the brakes on the economy, by putting interest rates up, as you can see, by sort of 7% or more. Obviously, if the central bank today was to respond to higher oil prices by putting interest rates up by 7%, it would very quickly trigger a recession in the US. But we don't think that's what's going to happen. We think that the central bank is going to have some of the tightening done for it by higher oil prices. If you think central banks are worried about domestically driven inflation, and to dampen those domestically driven inflation pressures, central banks try and take some of the money away from consumers, so they're spending less on goods and services and therefore dampen price growth. But higher oil prices do that for them. It obviously leads to higher headline inflation, but it means that consumers are spending less on fun stuff like going out to restaurants and going on holiday or buying stuff that they want, and instead they're spending more on filling up their car. So I would think of higher oil prices as doing some of the monetary policy tightening for the Fed. And therefore, our base case is that the central banks will tighten policy at a slower pace because the higher oil prices will weigh on growth and already have done some of the tightening for them, at least over the next 12 months. The risk, though, further out, is that if we don't get a recession and the central banks are slower to put interest rates up because the oil price weighs on growth, but it doesn't cause the unemployment rate to go up, then could it mean that next year or the year after that, inflation picks up further and the central banks have to put interest rates up faster and further than before? And if you look at slide 10, which is on the next page, the risk that some people are worried about is that if there's not a recession, if growth merely slows down, but the unemployment rate stays low, then could that lead to consumers being able to bargain for higher wages, wage growth already running at about 5%. And you can see that historically, if inflation is low, then consumers don't tend to get as high pay rises. But if inflation picks up, obviously consumers want more wage growth to try and offset that inflation. And in periods where the labor market is not very tight, in other words, when unemployment is high, they might want a pay rise, but it's very hard for them to bargain to get it. But when the unemployment rate is low, it's much easier for them to bargain to get those pay rises. So if you look at the next slide, what's been incredible about the recovery from the pandemic has been the speed of decline in unemployment. If you think back to the financial crisis, it took 8 years for the unemployment rate to fall from 10% down to under 4%. This time around, the unemployment rate peaked 5 percentage points higher at 15%, and yet is already back down below 4% in less than 2 years. And you can see that there's this inverse correlation between unemployment and wage growth. When unemployment is low, wage growth tends to pick up. So there's a risk that with unemployment low, if the unemployment rate doesn't go up, if the high oil prices don't cause a recession, it could mean that by 2023, wage growth is running stronger, and then the central bank feels like they do need to put interest rates up perhaps faster and further because they've gone slower this year in the face of that slowdown from oil prices. And I think that is a risk, but a couple of points I would make. Firstly, US consumers are less exposed to interest rate rises than they were in the past. In 2007, about 20% of people in the US were on tracker or adjustable rate mortgages. Today, 95% of mortgages in the US are fixed, and about 80% of them are fixed for 30 years. So as interest rates go up, it will have less of a negative effect on the US economy than it did in the past. The other thing I think one should bear in mind on page 12 is that wage growth is correlated with unemployment, but it's also correlated with sales growth. So even if unemployment stays low, if sales growth comes down significantly, it's going to be less easy for people to bargain for higher wages. Now, this year, wages are running at about 5% growth, but that's because sales growth for the US companies, shown here in the S&P 500, grew by more than 20% over the last year. If the oil price means that actually S&P 500 sales growth slows down materially this year, perhaps doesn't cause a recession, but slows to a much slower pace, then that means that companies will have less money to pay higher wages, and therefore that risk of a wage price spiral would be lower. So look, in summary, the key questions that we need the answer to are what's going to happen to the oil price, what's going to happen to gas prices, particularly how it affects Europe and the UK. The risk of a recession in Europe and the UK is certainly higher today, given where gas prices are, but it's going to be very important what happens to gas prices. Do they continue to fall as they have in the last few days, in which case that recession could be avoided? If they don't, then to what extent will government step in and provide support for consumers to deal with those higher prices? And I think it's quite likely that you do see some further support there. And in the US, at the moment, we think that oil prices are unlikely to be high enough to cause a recession. Obviously, if they spike further, that could change that story. And our base case is that the central bank, the Fed, will put rates up slower this year than the market expects, because the higher oil price will have already done some of the tightening for them. So I'm sure there's plenty of questions which we'll deal with in the Q&A, but first of all, let me hand over to Kevin again. He's going to talk through some of the implications for the South African economy.
Thanks, Mike. That's great. Yeah, I think a lot there. We've had quite a few questions, so I'm going to come back to that, particularly around obviously market implications. But let me just go through some discussions around what this means for the SA economy specifically. All righty, so there are two key things that we're watching. The one is, what is this? And the ones are positive and the others are negative. So the positive is obviously what this is doing to commodity prices, what this will do to our exports. We generate more revenue. The government is probably smiling because tax revenue is going to hold up very nicely. And there is out of that a net benefit for South Africa in terms of stimulating mining and some other sectors, and also just providing a little bit of a growth initiative. So there is a positiveness, bizarrely, right, for South Africa. The negative, of course, is what this does to a range of other things, inflation, particularly through the petrol price, through food prices, what this does to confidence, because now you've got another conflict that is severe and we're just getting over COVID. What this does to investors' appetite to start to move money into emerging markets. Is there an unease around that? There are a lot of other quite important implications. And unfortunately, from my perspective, right now, my view is that the negatives outweigh the positives. And I want to explain why that is. All right, so as I said right up front, South Africa doesn't do a huge amount of trade with Russia. The trade that we do is very seasonal. Now, this chart on the screen doesn't show that seasonality on purpose because it's a 12-month moving average. But if you looked at the data monthly, gee, it's all over the place. And a lot of that has to do with the fact that our trade with Russia is largely agricultural based. So in any particular year, it does depend on seasons, our season, their season, and the particular crops or food products we trade in. So the flows are very seasonal and very erratic, but in general, they're small. Exports are less than 0.5% of South Africa's exports. Our imports are less than 1%. We import more from Russia than we export. We run a trade deficit with them. But as I said up front, it's not a significant focus. And there hasn't been any initiatives really in South Africa to actively promote trade with Russia. Even though Russia's part of the BRICS system, we haven't had a big focus there because there aren't great overlaps and natural linkages. We export a lot of the same commodities they export. There isn't a natural link up. We tend to promote trade much more in the BRICS system with India, with China, because there's obvious and natural benefits for both parties. But with Russia, it's less obvious. If you focus on the Ukraine never comes up for discussion in South Africa's economic context, and our trade is less than 0.1%, and 0.1% is being generous. And again, if you break down that trade, it's mostly in the I think it's fruit juices and in the fruit industry. But Beyond that, it's very, very small. So the direct link or the direct economic impact of the Russia-Ukraine crisis on South Africa is very, very small. It's all about the indirect link, which is what Mike was highlighting, that it's all about what does this mean for prices? What does this mean for commodity prices? What does this mean for the oil price? What does this mean for global inflation, global interest rates? All of those things are absolutely critical. So in the SA context, we are enjoying this benefit. So this is the global commodity price index. It's a daily index, and you can see how the number has escalated. So this is broad-based, right? So it would include industrial commodities, but it includes soft commodities as well. So the food basket, the grains, the wheat price, which has rocketed, all of that is included in this data, and this number has gone up very dramatically. And we tend to export a hell of a lot more commodities than we import. We do import stuff from time to time, but it's not all that significant. And if you look at the percentage increase in this commodity basket, this is weekly numbers. Last week was the single biggest weekly increase ever recorded in commodity prices in dollars. Phenomenal, 20% in a week. Now, clearly, some of these prices have come down and they've settled a bit. But you would have to argue, I think, that the sanctions against Russia are going to remain in place for some time, even if the conflict resolves itself, right? Those sanctions aren't going away anytime soon, and they're going to remain severe, and they're going to remain on a protected basis, as in it's possible they remain around for years. And it's going to generally elevate commodity prices on an ongoing basis. There will be some responses from industry over time. So don't factor in higher commodity prices forever. There will be an industry response, but certainly over the coming months, our view would be commodity prices remain elevated across the basket. And as I say, some of them are good and some of them are bad effects around the world. The other thing that stands out with this crisis is that most currencies have come under pressure, right? So if you look at the Russian ruble, you can pick a day, but it's down 30 to 40% since the beginning of this year. And many other currencies have come under pressure, particularly those countries, those emerging markets that are very close in Eastern Europe. So something like Turkey, Poland, Hungary, Czech Republic. You can understand that the proximity to the crisis is really what starts to undermine your currency, and that you get worried that this could spill over into neighboring states, and therefore there's a nervousness. But have a look at the currencies at the bottom, those 5 currencies at the bottom, which have done actually, you would have to say, spectacularly well under this environment, given that the dollar itself is strong. And the commonality between those 5 currencies at the bottom is the commodity element. And so this commodity price effect is not just helping the miners in terms of revenue, it's actually cushioning the impact of the crisis on South Africa because it's keeping the rand relatively stable. You would have assumed going into this crisis that the rand would have been substantially weaker than it is. But it's been remarkably strong, and it's got nothing to do with our economic fundamentals, right? So we're not doing anything different. In fact, we're messing up more than ever before because of load shedding. But the commodity element is such a strong factor that it's helping with inflows in terms of export revenue, and it's clearly making emerging market currencies that have commodities stand out. And this is no doubt cushioning the impact of the oil price on our petrol price. And without this, it would be an even more of a severe impact in terms of petrol price hikes and what that means for inflation. So we've got a positive for export earnings, and we've got a positive in terms of the currency. Now, this positive has been playing out for some time, right? So commodity prices have been elevated, were elevated last year. This has not just come about because of the Russia-Ukraine crisis. And because South Africa's economy is quite weak, we haven't been importing. And so we've gone through this phase where we've generated these massive trade surpluses, beautiful stuff, right? And that's pushed us into a current account surplus, and that's generally been good. And we know that a lot of that has come through from the commodity cycle. So you've got to think of this commodity cycle as started some time ago. It started to dissipate towards the end of the year into the beginning of this year. And then the Russia-Ukraine crisis came along, and that's reinvigorated the commodity story for different reasons. And now you do have a return of supply constraints. If you look at news coming out of Europe, there are businesses who are closing down because of higher energy, gas prices. They're certainly curtailing operations. The sanctions itself is going to create some global supply disruptions. And so we're back into a similar narrative that we had last year, but for different reasons. Obviously, in the previous run-up, it related to COVID. Now it relates to Russia-Ukraine, but there are similar effects. So we're going to continue to enjoy this. We would expect that South Africa's trade surplus will rocket again, right? Imports are going to remain low. The economy is quite weak. We're not importing. Exports are going to get another surge, and we're going to go to a better trade surplus over the coming months. So all of that, good news. There's nothing wrong with any of that in terms of the South African context. And we know from the tax revenue that the government is into another bumper tax revenue phase. So I'm just showing you, have a look at the chart where it's got mining. That is the tax revenue received from the mining sector on a monthly basis during the course of last year into the beginning of this year. And look at the red line and look how massive that tax revenue receipt was. A lot of that coming through from the platinum group metals. And platinum prices have gone up again. Gold prices have gone up again. And those mining tax revenues dwarf anything that we can reap from the manufacturing sector in terms of manufacturing tax revenue, right? But what it means for government is you're now going to have another overrun, another windfall of tax receipts. And that's going to put us in an even better position from a fiscal perspective. It's going to give National Treasury more options in terms of reducing their borrowing requirement, effecting fiscal discipline. They've got some scope should they need to spend some money. And so when you look at it from this perspective, gee, it sounds good, right? This sort of crisis is good in commodity producing countries, and in the South African context, because of the tax revenue benefit, there's an upside. Now, many people draw the conclusion that what's going to flow from this is a boost to our mining activity. And unfortunately, that's where the positive doesn't carry through. And that's what you would want. You would want our mining industry to step up, because obviously there are now going to be shortages of commodities in the world because Russia can't export. There are going to be people looking for those commodities. South Africa supplies those commodities. And therefore, this is a beautiful opportunity to ramp up production and get not just a value effect, right? Get a volume effect. Unfortunately, when you look at mining production in South Africa, and this is just volume of mining, what would you draw as a conclusion from this chart? You would say, this just goes sideways, right? And that's going sideways during the course of last year when we had spectacular commodity prices. If anything, it weakened towards the end of last year because the mines got affected bizarrely by the rainfall. The mines got affected by railway line breakdown, by port capacity breakdown. So the problem is we're not deriving the full benefit of this commodity cycle. We're not investing in mining activity. We're not expanding the production of mines, because if you talk to the miners, they tell you that there's no point investing. If they invested and they mined more stuff, what they're going to do with that more stuff? The railway line is operating at 100% capacity when it's not broken. The ports are operating at 100% capacity when they're not broken. So you're not going to be able to export the stuff because you have an infrastructure bottleneck. So yes, the mines will generate better profits. They'll pay good dividends. The government will get more revenue. But the multiplier benefit of this through fixed investment, employment, knock-on benefits to manufacturing and other sectors, that's not there. And so there's a limited upside. We should be enjoying a much bigger upside from this crisis. sad to say, we could enjoy a bigger benefit from this crisis and step into the gap that Russia is leaving. But we're not able to do that because at a critical time, we just don't have the infrastructure capacity to deliver. So what's the negative? The negative, obviously, is that petrol prices have gone up. In the US, they've gone over $4 a gallon, the highest they've had. In South Africa, at this stage, if things remain unchanged, we're looking at close on a 3 Rand a litre increase in the petrol price at the beginning of April, right? And that assumes that Europe doesn't block the oil imports from Russia. So there's still some risk around this. And this is with a currency that is doing fairly well. Now, unfortunately, the 3 Rand a litre plus the previous 2 increases in the fuel levy, none of that's in the inflation data. So what's going to happen is this is going to go through to our inflation data. And obviously, our inflation rate is close to the top end of the target, 6%. But it means that our inflation rate is heading towards 7%, right? So it's going to go above the target. It's going to stay above the target for some time. And that's going to create a lot of anxiety in South Africa, partly from the Reserve Bank. I don't think they'll accelerate interest rates. I think they'll continue on at a steady pace. They're going to continue to raise interest rates, but I don't think they'll become more aggressive for the same reason that Mike highlighted in Europe and the US, because in effect, your petrol price is doing some of the work of the interest rate hike, but they'll still put up interest rates further. So the consumer is not going to enjoy this at all. Now, the reason this matters is look at the breakdown of income in South Africa into quintiles, 20% brackets, and have a look at the weighting in the bottom quintiles that those people spend on food and on public transport. So if you're a low-income earner in this country, you spend 40 to 45% of your income on 2 things, food and public transport. And those prices are going to be under pressure, right? And so that's going to be taking a huge amount of your little income. At the higher end of the income spectrum, less of an impact. So what's this going to do? It's going to aggravate the social dynamic in this country. It's going to worsen the environment for unemployed, for low-income earners. It's going to place more pressure on the government. We're not going to stimulate growth as a consequence of this because we can't get the uplift through the mining sector. And so we're going to get a lot of the negative in a very substantial way. And that negative is going to hit us at the end of this month when you get a 3 Rand a litre increase in the petrol price. And then there's risk beyond that, right? So unfortunately, in my mind, this risk is going to outweigh the benefit in terms of the economic effect. The government obviously net out of this benefits because they get the extra tax revenue. But for the economy as a whole, it is a significant negative. I think I'm going to stop there. I'm worried about time, and I want to get back to what Mike was chatting about and some of the questions. So let me stop the sharing bit of it and ask Mike to just join us again. And I just want to chat through some of the potential ways this could play out, Mike. And there are 2 scenarios that I just want to run past you and get a sense from you as to how you feel about this. So let's assume scenario 1, right? Scenario 1, Russia continues with their military action in the Ukraine. It's unconvincing at this stage, but they continue on. And just by sheer numbers, just by sheer force, they overwhelm the Ukraine economy, the government. They take Kiev. They arrest a whole lot of officials. And they put in place their own government, right? And then they dress that up as a legitimate government, however Russia does that. And then they try and withdraw their troops, and now they, in their minds, are controlling the Ukraine. But obviously, a lot of Ukraine citizens are angry, and they are, wherever they can, disrupting the Ukraine economy and disrupting the Russians in their efforts. So you've got a dysfunctional economic system. But it allows Putin to go home and claim victory, and he kind of leaves a mess behind him. What does that scenario mean for the critical prices? In other words, what does that scenario in your mind mean for the oil price, for the continuation of sanctions, for commodity prices broadly? And I guess also for what does that mean for economic growth in Europe? That type of scenario where Putin's claimed victory, but it's a hollow victory. And it's an unconvincing victory, and he's inherited a mess.
So I think it depends on whether that causes further escalation in terms of the Europeans actually cutting off their imports of oil and then Russia retaliating by cutting off the gas. So step by step, as further incursions into Ukraine have taken place, the sanctions are being ratcheted up. As you say, the obvious next step is for an attack on Kiev. The risk is that that could be very, sadly, very bloody and terrible for the people of Kiev. And if that makes Europe feel like it has to do more on sanctions, then, that could lead to a very significant further spike in oil prices and gas prices. It may be that Europe just decides this is so awful that we need to take the economic pain, try and provide some kind of support to the economy. But, in the event that the gas was actually cut off, a European recession would be almost inevitable in that scenario. That said, it's also possible that Europe sees that happen and just thinks, look, actually, we can't take the economic pain and risk the gas getting shut off. And we can't even really afford the risk of the spike in oil prices if we were to stop taking Russian oil. So dreadful and terrible as it is, we basically just need to stand by and, maybe put some more financial sanctions in place, but not prevent the oil exports from continuing to flow, and hope that the gas exports continue to flow and that Russia don't cut that off. So it's really all about how the West and Russia react to that potential further attack on Kiev. If the gas continues to flow and the oil continues to flow, then there's a good chance that gas prices would come down more, because I think the market would view that as, basically getting close to the end game, even though there would be ongoing, as you say, insurgency in Ukraine. The market would probably view that as, well, this is the end game. Putin has kind of achieved broadly what he wanted to achieve, and that the risk of further escalation is therefore less likely. Whereas if in the process of getting to that point, further escalation involves a massive spike in oil prices and gas prices, then that could certainly trigger a recession in Europe and the UK. And if I think if oil prices went north of $150 a barrel, then the US economy would be at risk too.
Mike, there's a question around the oil and gas thing, and the question is, can Europe phase out its dependency on Russia for oil and gas? Is that realistic in any time frame? Well, I assume it's realistic in a long time frame, but is it realistic in a 12-month time frame?
Not in the near term. As I say, about 40% of all Europe's gas comes from Russia. And even if they competed for the liquid natural gas that's available from Asia, the price to do that would be so high that it would, almost certainly be very problematic for the European economy. So no, really, there isn't a very viable way that Europe can cope. I mean, they could shut down and pause industrial activity for a period of time, but there's no way of doing it that doesn't cause severe economic damage in the near term. Obviously, what I think it will do is it will accelerate the long-term goal of shifting towards renewable energy. Now, exactly how long that takes, I don't know, but we're probably talking 10 plus years rather than 10 months.
Okay, Mike, can I just give you another scenario? We've got 6 minutes left, and I know you've got a hard close at 11, but let me just give you another scenario, the second scenario. The second scenario, the boss of Ukraine has been kind of, in my mind, the spearhead for the pushback against Russia. NATO has not really, it's kind of backed away, and it doesn't want to really be at the spearhead of that pushback. So Ukraine is doing the heavy lifting, right, in the pushback against Russia. And at some point, the boss of Ukraine says, you know what, NATO's not really helping us, and that we just lambs to the slaughter here, and we have to change tactic a bit. And we've got to think about our own survival. And in order to do that, we are going to announce that we're not going to join NATO. We are going to say that we are going to remain neutral within Europe and therefore potentially not a threat to Russia by joining NATO. So we're going to announce that we're not joining NATO, which is one of the conditions that Putin wants. So you're kind of giving in there. We are going to give up the 2 separatist provinces where there has been fighting already. We'll do a deal around Crimea, and in response, we're going to get sort of a peace and a withdrawal as a way of ending the conflict. So you give Putin something he can go back and brag about, that he's gained victory in some way, and in effect, the Ukraine becomes less of an ally for NATO, right? What does that mean for markets? What does that mean for oil and for commodities and general feeling in Europe? Does it get better quite quickly?
I think that in that scenario, I don't know how likely that scenario is, but in the scenario of essentially a de-escalation, as long as it didn't lead to, at some point along the way, the gas getting shut off and a big spike in energy prices, it would probably lead to energy prices coming down quite sharply. And, that could lead to a rally in European stocks, in UK stocks, if the markets viewed that as a diminution, a decrease in the risk that you're going to get this big oil price spike and gas price spike or shut off that is what the market is really worried about. So the politics of it aside, from a market perspective, that kind of de-escalation scenario would probably be quite positive. I think, in terms of thinking about the end games here, it seems to me, and I'm certainly no military or political expert, but it seems to me like the way out of this, it needs to be that Putin can at least have something that he can sell to the Russians at home, that he has had a victory. Now, exactly what that looks like is hard to say, but it seems to me like that is the only way out of this, that Putin can get some kind of outcome that he can sell at home as having achieved what he wanted to.
Okay, last thing, Mike, we've got 2 minutes and I'm using up all of my 60-minute allocation with you. What is the critical thing for us to watch now? From you're involved in the markets on a daily basis, you're looking at strategy, investment, all kinds of things. What is the thing that you're watching the most from here?
I think, the 2 key things I'm watching are the news around, are Europe going to stop taking oil from Russia? Because if that happened, I think the risk is that they would see Russia shut off the gas as well. So far, the Germans have said, no, we don't think we do want to stop taking oil from Russia, even though the US and the UK have said that they will stop it. So if that changed, if something changed that meant that actually the Europeans stopped taking oil, or indeed that the Russians retaliate to some other form of sanctions by shutting off the gas, then that is a really very negative outcome for the European and UK economies and for markets. So I've been watching that very carefully. And then the other thing is fiscal stimulus. We just have to think back to COVID. the market bottomed in March of 2020 and the vaccines didn't become available until November. And why did the market bottom? The market bottomed because of absolutely enormous fiscal stimulus from governments around the world. So if the gas doesn't get shut off and governments in Europe and the UK step in and announce that they're going to send via tax cuts or perhaps even just checks in the post money to consumers to help them deal with this higher period of energy prices, because in some ways, the justification for that during COVID was to say, well, this is not anyone's fault. Again, you could argue that these higher energy prices, they're not the fault of European consumers. So perhaps the government announces that they step in with big fiscal stimulus. And again, as long as the gas doesn't get cut off, that could be received very positively by the market. So those are the two key things that I've been watching. And I think it just shows the difficulty of, getting whipsawed, because if one panics about all this, thinks that it's going to go in the wrong direction, and then the government step in with big fiscal stimulus, it could lift markets. Of course, on the other hand, if the gas gets cut off, then there could be significant further downside. So it shows just how difficult it is at the moment.
Yep, it is extremely difficult. Throw in some load shedding and you've got South Africa. So thanks a lot, Mike. Thanks for your time. Really appreciate your insights. Guys, please, just to remind you, the presentations are available. A recording of this will be available. I haven't had a chance to get to all the questions. Hopefully we've covered some of that, but we really appreciate you joining us this morning. There are lots of opportunities to link into different webinars, and so the fact that you've chosen to link into this, highly appreciated. And hopefully as things evolve, we keep updating you with a range of different topics and webinars. Please shout if you want to hear something very specific. We can take that on board. But other than that, enjoy your Friday, enjoy your weekend. Hope load shedding eases off. Thanks, guys. We'll chat soon.